Hey everyone, me Kevin here. So stocks are starting off a little red today, and there are quite a few reasons. Let's talk about those. Have to do with the ECB. We'll talk about incomes and demos. We'll also talk about zombie companies, and this is a really big one because a lot of our favorite names have this issue, and they've been issues that I've been talking about regularly, whether it's on this channel or also to course members, where one of the big things that I worry about, especially in times like this, is stay away from heavily indebted companies. There's a reason why indebted companies can survive when rates are 0%. But guess what tends to happen when rates actually start moving up and you've got zombie companies still reanimated? So stay tuned for that. We'll talk about that during this video. But first, let's talk about the ECB. The Eurozone just had an inflation report that came in a lot hotter than expected. The survey was for a 7.8% estimate for inflation in May, and we came in with a jump of 8.1%. So we missed by about 0.3% there, which is not so great. Even though core was substantially lower, that headline inflation is still going to lead to concerns that the ECB might end up going with a hawkish 50 BP hike as well. This is really similar to the Fed, except you have to remember that the Eurozone is so much more used to deflation and negative interest rates than the Fed. So if we get some kind of 50 BP hike over at the Eurozone, it'd be a lot more of a shock to markets than most are pricing in. Markets right now are pricing in about a 25 basis point hike, maybe in July. Keep in mind, ECB still has not raised rates, right? So to go from 0 and the expectation that maybe we'll get 25 in July to all of a sudden seeing like a 50 because of higher oil prices, Brent's still sitting at like 120 bucks a barrel. It's pretty wild. That could actually lead to some global tightening in emerging markets. And I know some folks might think, well, Kevin, I only care about the United States market. But remember, if one market like the Eurozone market gets substantially more inexpensive, that is, their stocks get more expensive, you do end up seeing a demand shift from the United States to a cheaper market, whether that's from the United States to China or the United States to Europe. And so then that reduces demand here, which then potentially reduces prices here as well. It's all connected. Now, of course, last week, what we saw at the end of last week was potentially what some were calling a little bit of a tactical rebound, and that was basically founded in the idea that, okay, well, maybe the Fed has reached its peak tightening, and maybe fears of a recession are overblown because people keep spending money, although the more people keep spending money, the more we kind of get this weird balance where it's like, okay, well, if the Fed's tightening, but people keep spending money, then maybe the Fed needs to tighten even more to actually bring inflation down. But we did see a little bit of the bounce last week. Not necessarily sure if it's going to continue. Obviously, a lot of folks are hopeful, but I'll tell you, there is so much fear and uncertainty and doubt out there right now that it's really hard to call any kind of bottom in this market. This probably been one of the most difficult markets for really anyone to predict, whether they're institutions or individuals. But let's talk about those zombie companies. So zombie companies, this is an important one. Zombie companies are companies that don't make enough money to literally just cover their interest expenses. And I hate to give you some of the big names here, but I'm going to do that right after I remind you that today's the day that prices are going to be going up on the programs on building your wealth. They're all linked down below. We'll keep this one short. You know it. You've heard it before. But today's the day. So this is going to be the largest increase because we've got a huge set of new lectures coming out by the middle of next month. They're already set. A lot of them ready to go. More of them being recorded. So super excited for those coming out, especially the Wealth Path course, even stocks and psych, you name it. So, and of course, real estate. Boy, we've got stuff coming for real estate. It's going to be fun. But anyway, big names that are zombie companies right now. AMC, folks. AMC, American Airlines, Carnival Cruise Lines, and these are companies that I've been looking at, but I keep stopping myself from wanting to buy, with the exception of the AMC shares that I do already hold, because I promised I would hold those shares for a year, which we're actually probably at a year right now, but I'm still holding them. And what's fascinating is that zombie companies, as I alluded to earlier, are companies that you can really get by and survive with when it's easy to borrow money. Remember the bond raises these companies regularly did when rates were 0%, and as soon as the potential depressionary fears of the COVID pandemic went away, what happened? Well, all these companies were able to borrow and refinance at lower rates. Carnival was previously borrowing at like 17%. They were able to get down to 11%, and then you get down to 6%, and so on and so forth. Well, that's all fine and dandy when Federal Reserve rates are 0%. But it's a big issue when you need a lifeline now and rates are going up and you're facing rampant inflation in the market. we've already seen a 75% decline in bond raises by zombie companies this year. And it's a clear sign that even if they wanted to raise money, it's gotten really hard to raise money. In fact, we've got a chart, I'll pull it up really quick, and it gives you a little bit of an idea about what's happening in the bond market, especially the junk bond market. And you've really seen a U-turn at the beginning of this year. Take a look at this on screen now. So this is your junk bond pricing here. And you're seeing that junk bond pricing kind of plummet here at the beginning of 2022. And look at the other times on this chart that you've sort of seen this plummet. You had it briefly during the beginning of the taper tantrum over here in 2016. So you tend to see the pricing for these go down. And when pricing goes down, this means yields go up, right? And yields going up is very, very bad for zombie companies, because zombie companies don't want to have to pay even more interest to try to get financing to stay alive. Remember, zombie companies still means you're burning more money in just interest than you're actually making, which is pretty wild. But take a look at that nice plummet we've got over here in that junk bond market, which is kind of similar to what we saw over here in the COVID pandemic. Not quite, obviously, still probably have another 50% or so to go, but you see that inflection point beginning. And so even when we see in private capital markets, it's harder for people to fundraise now, it's no surprise that junk bonds, especially from zombie companies, are going to be even harder to get money raises done in, which is really bad because for them at least, but some say it's actually really healthy, because what ends up happening? Well, you'll get a large cleaning that happens, essentially a bunch of bankruptcies. So very, very likely that you get a lot of bankruptcies if we continue on this high inflationary path, high interest rate path. The zombie companies are going to start turning over. And in the last few years, we now have about 20% zombie companies out of the United States' largest 3,000 companies. So think about that. With 3,000 of the largest companies in the United States, 600 of them are zombie companies. Again, companies like American Airlines, Carnival Cruise Lines, AMC. A lot of the names that became sort of meme names have, or what I like to call momentum names, or at risk. There's a chopping block there. So you do really want to be careful that even though we could see these like nice, 10% movements on like an AMC, or big swings on smaller companies, especially the reopening trades that became such momentum names, whether it was Carnival or the airlines or whatever. You've got to be really careful, because when it comes time for them to raise money in this kind of market, could be the end of the company's ability to operate. It's just a warning. So another thing that we've noticed, and this is just a little bit more historical, and it's just an interesting chart to look at, is how incomes have changed over the last 50 years for folks. Take a look at this chart right here. So this is a chart of how incomes have changed again, and you could say over here that incomes for those in the upper echelon, upper income, so probably top 20, top 30% or so. Actually, 219,000, this would be more like the top 5%. Anyway, top 5% folks of income has gone up about 61%. So you've seen a 61% increase at the top, whereas at the bottom you've seen about a 45% increase in income. So again, kind of showing off that sort of difference in how wealthier people are getting wealthier. There's similar charts on this obviously for race as well, and one of the big differences continues to be home ownership. Home ownership being one of the big reasons why you see wealth increase substantially more for whites and Asians than blacks and Hispanics. Home ownership, huge difference. Remember that the average net worth of a homeowner is somewhere around $170,000, $180,000, whereas the average net worth of a tenant is somewhere around $5,000 to $6,000. And if you're one of those folks who believes, oh, well, I can make more money investing my down payment or whatever than in the stock market than I can in real estate, I think you're sorely mistaken, and you should absolutely check out that Zero to Millionaire Real Estate Investing Program, because there are so many easier, safer ways, in my opinion, to make money getting started in real estate than getting started in stocks. Okay, next we have, so we talked about bonds, we talked about this, options. Yeah, we want to talk about options, and we talked about the ECB. Okay, options. So this is interesting too, and it just sort of highlights a little bit of the pessimism that we're seeing. in the market right now. This is our chart of call option buying right now. And, you know, you can see over here, during our last massive rally over here, we have massive call option buying because it was really, really easy to make money on calls because you could buy them and just hold them and you'd make money. Same thing over here. I mean, look at how much sort of buy and hold call options essentially we had here by continuous buying, right? And compare any of that to this small level over here of call option buying you're getting. And it makes sense because a lot of these call options, you know, are just, you know, evaporating. Call options, I think, are terrible in this market. I think the only reason you'd want call options is to prevent yourself from going into margin or going into, you know, essentially heavy speculative positions. So during the time of this recording, we've seen the QQQ drop to about 1%, SPY's just down about 1% as well. Tesla went from positive to slightly negative, and this is probably because we're seeing a little bit of that pricing in of, okay, how do we handle the pain that we're seeing of the ECB rate hike cycle now? Like if we've got a clear path of the Federal Reserve's rate hike cycle, how is it going to work when the ECB potentially becomes more hawkish, right? And we just continue to experience pain. This is why even when we get 2 days of rally, it's really important to remember, stay out of margin and stay safe. Right now, you've got the 10-year back up to 2.85. You've also got oil, and this is a big one. You've got oil, WTI sitting at 119. That's pretty substantial. In addition to that, you've got a Brent sitting at 124. It's pretty high. And so we're going to see some of those headline inflation numbers actually head up rather than down because of these levels of oil and energy. Now, the good news is we just got our Chicago PMI read for May. It looks like we got a read of 60.3, which was much better than the estimate of 55, and that's versus the prior read of 56.4. It's entirely possible that because of that PMI print, we are getting a little bit of these green candlesticks right here, as that just came out within the last couple of minutes here. So fascinating, but anyway, expect that volatility. I think it's very easy to get sort of coaxed into this idea that, oh, couple risk on days, we see, you know, big moves, especially in whether it's AMC or a firm or airlines or whatever. And so we see these huge moves where, like, a firm, for example, goes from 23 bucks to 30, and it just makes us feel like, oh my gosh, we can't get hurt, like, pile in. Be careful. The biggest number one thing that I always recommend is stay out of margin. The reason for that is you don't want to go bankrupt in these kind of times. And this pain can last all freaking year. We are not out of the woods at any point in this year, so don't rush too much into these markets. Anyway, that gives you an update as to what the heck is going on. And check out those programs on Building Your Wealth, linked down below, because we've got a coupon code expiring today. All right, so let's see what kind